Welcome back to the deep dive. Today, we're doing something a little different. We are opening up a kind of financial time capsule.
Yeah, that's a great way to put it.
We're taking a single, really iconic textbook case study McDonald's from way back in 2012, and we're slamming it right up against their current, their 2024 SEC filings.
The head-on collision.
Exactly. You send over the data, the research notes, all the excerpts. And our mission today is really to understand one thing. How did a company this famous, this stable, completely rewrite its financial identity in just a decade?
And these aren't small changes. We're not talking about little tweaks.
No, not at all. Changes are structural, they're dramatic, and honestly, they pretty much flip every introductory accounting assumption on its head.
Right.
The core of the shock. I mean, it's just staring at us from the balance sheet. In 2012, McDonald's looks, healthy, balanced, classic American company.
It's textbook example.
In 2024, it looks like a high-octane hedge fund that just happens to sell burgers. The whole relationship between debt and equity has been, well, it's been inverted aggressively, deliberately.
Yeah.
Okay, let's unpack this.
Exactly. And for anyone listening, if you're studying for a finance exam or, prepping for a big meeting, or you're just curious about how modern corporate finance really works, this deep dive is for you. Because this isn't just about McDonald's. It's a masterclass in aggressive capital management. We're seeing how a deliberate strategy can just fundamentally reshape a company's entire financial structure.
And it illustrates all those core accounting concepts.
In the most dramatic way possible. But before we dive into the raw numbers, we have to ground ourselves in the business model.
Right, context first.
Because the financials are only the result of the business decisions. And McDonald's made a huge one. They finished their transformation from being a restaurant operator to being, first and foremost, a franchisor, a global real estate company.
That distinction is everything, isn't it? Our sources make that crystal clear. This is not about selling fries anymore.
Not primarily, no.
We are looking at a system of just colossal scale. I mean, the latest data says 43,477 restaurants worldwide. But here's the kicker, the key data point.
Go on.
An astounding 95% of them are operated by independent franchisees. 95%. That's almost 41,000 locations that McDonald's doesn't have to staff or manage day to day.
And that completely dictates the financial reporting, especially how they recognize revenue.
Yeah, let's talk about that.
Well, if you go back to the textbook, system-wide sales, so all the money customers spent on Big Macs and everything else globally, that might be close to, say, $88 billion.
A huge number.
A massive number. But when you look at McDonald's corporate reported revenue, it's often less than a third of that.
And that gap, that missing two-thirds, that's the first real aha moment for the listener, right? Their revenue isn't tied to the price of a hamburger.
Exactly. Their revenue is tied to rent, royalty payments, and fees that they charge those 95% of operators. They're charging for the right to use the brand, the Golden Arches, and, crucially, for the land underneath the restaurant.
So they're basically a global landlord.
A global landlord with an incredibly stable income stream. The franchisee pays rent and royalties whether they had a bad week because of a storm or a local labor issue. McDonald's has engineered this model where their income is just. It's incredibly predictable.
Which carries a lot less risk than running the stores themselves.
Far lower risk. And that stability is what allowed them to make the, as you said, terrifying financial decisions we're about to look at. They capitalized on it.
How so?
Well, that stable cash flow, it acts like prime collateral. If you're a bank, you feel very, very comfortable lending tens of billions of dollars to a company that knows with near certainty that 41,000 rent checks are going to clear every month, every year.
That security lets them take on a high leverage strategy.
Percent.
Okay, so here's where it gets really interesting. This is where that classic conservative 2012 textbook company just gets decimated. We're comparing the 2012 balance sheet to the 2024 reality. And we should probably slow down here, let these numbers really sink in.
Let's do it.
Let's start with total assets. In 2012, they were at $35.39 billion. By 2024, they had grown to $55.18 billion. So, solid growth. About a 50% increase over the decade. Nothing too shocking there.
Right. That makes sense. Reinvestment, new properties, normal stuff.
But now, the shock. We move to the other side of the equation, liabilities.
And specifically, total debt, long-term and short-term combined. In 2012, it was approximately $20.09 billion.
Wait, what was the 2024 figure again?
$51.95 billion.
Wow. Okay, so that has essentially doubled and then some. Assets grew by 50%, but the debt The debt load grew by over
Because
150%.
it's an aggressive, intentional, almost unprecedented buildup
Yeah.
of leverage.
So they intentionally took on debt almost equal to their entire asset base. But that's not even the craziest part, is it? The truly startling pivot, the one that screams at you, is what happened to owners' equity. In 2012, McDonald's had a robust positive equity of $15.29 billion.
And by 2024, that figure has completely collapsed. It's dropped into negative territory.
The one number.
Negative $3.80 billion.
Negative $3.8 billion. Yeah, okay. For a student, negative equity in a massive, profitable company it's a huge red flag. It implies the company owes more than it owns. It suggests insolvency.
And that's exactly why this is such a critical teaching moment. We have to
Yeah.
stress this, that negative equity is not a mistake. And it does not mean they're going bankrupt.
Right. They're incredibly profitable.
Very. This is a major strategic departure. It's the deliberate result of management choosing to leverage the company to the absolute max, all to maximize shareholder returns.
Okay, but hold on. That sounds fundamentally risky. No matter how stable the cash flow is, isn't a $52 billion debt load potentially crippling if something goes wrong? A big economic shock or sustained high interest rates?
That's the billion-dollar question, isn't it? They are betting heavily against prolonged instability. The main risk mitigation is that stability we just talked about, and the fact they have rock-solid debt covenants with their lenders.
And they're a cash machine.
They are a cash-generating machine. Most lenders are looking at the cash flow statement, not just the balance sheet equity. If you generate enough cash, you can service almost any amount of debt.
So they're basically weaponizing their real estate model, using it as collateral to borrow cheap money,
Right.
and then putting that money somewhere else.
Exactly. It's financial arbitrage. They're playing the gap between their low cost of borrowing and the higher returns that equity investors demand. It means they've shifted their identity from a growth stock to more of a yield-based investment, a vehicle for massive, consistent cash distribution.
So the big question then is, where did all that equity go? How do you flip $15 billion of positive equity into negative territory?
And the answer isn't on the balance sheet itself. The answer, the storyteller, is the statement of cash flows.
Because they didn't use all this cash and debt just to build new stores. I mean, they did some of that.
Some. But they poured it back directly to the shareholders through dividends and, most importantly, share repurchases.
Let's break down that 2024 cash flow statement. It really does tell the story.
Okay, start where the money starts. Operations. McDonald's generated a staggering $9.45 billion in cash just from operating activities in 2024.
And that's up from, what, about $7 million in 2012?
Up from $6.97 billion, yeah. That strong, growing cash flow is the engine. It's what justifies the whole strategy.
And they do still invest in the business. Investing activities, they used about $5.35 billion for capital expenditures, new stores, updating things.
Right, you have to maintain the assets that generate the income.
But now we get to the crucial part, financing activities. This is where the aggressive shareholder payout happens, and it's why the equity tanked.
And the number is?
In 2024, McDonald's used a total of $7.52 billion just for shareholder returns.
And just to put that number in perspective, $7.5 billion is more than the entire market cap of some S&P 500 companies. It's a huge commitment.
So how did they deploy it?
Well, $4.87 billion was paid out in dividends. That's your consistent, reliable income stream for investors. And then $2.82 billion was used for share repurchases.
And we know that when a company aggressively buys back its own stock, that treasury stock action is one of the fastest ways to directly reduce stockholders' equity on the balance sheet.
It is. They're not just repurchasing shares, they're strategically liquidating their own equity position. It returns cash to investors in a very tax-efficient way.
So connecting the dots here, the story is crystal clear. You have massive, reliable cash from operations,
$9.5 billion.
which lets you take on huge debt.
$52 billion.
And you use that cash and debt to aggressively buy back your own stock and pay dividends.
To the tune of $7.5 billion in 1 year. The result is a massively shrinking owner's equity account that the buybacks push into negative territory while liabilities just explode.
And yet, the fundamental balance sheet equation still holds perfectly. Assets, $55 Bs, still equal liabilities, 52 Bs, plus equity, negative $3.08 Bs. The math is flawless.
The math always works. The lesson here is that the proportions are a profound reflection of management's philosophy. And their philosophy is maximum leverage, maximum shareholder reward, and betting the whole thing on the stability of those franchise checks.
Which brings up another core principle for you, the listener. Financial data is intensely dynamic. What was true in a 2012 textbook is ancient history now. You have to know how to find the real-time data yourself.
Absolutely. The textbook pointed you in the right direction, and we have to emphasize this again. The gold standard is the primary source. That means the SEC's ADR
Yeah.
database.
ADGAR.
Think of it as the Library of Congress for corporate finance. These are audited, legally binding documents. You search for McDonald's and you look for the Form 10K. That's the big one, the annual report.
And the data we use today was from the 10K filed for the year ending December 31st, 2024. For more recent stuff, you look for the 10Q, the quarterly report, or the 8K for time-sensitive news.
Right, like we cited an 8K from November 5, 2025. That's how quickly you can get fresh data.
And you can use secondary sources, right? Yahoo Finance, places like that.
For sure. They're great tools for quick summaries. But if you're making a critical decision, you have to verify those core numbers against the official SEC filings. Always.
Okay, so stepping back from the numbers for a second, let's go back to that profound question from the textbook a decade ago, which is maybe even more relevant today. Could more than half of McDonald's value be off the balance sheet?
Even with assets at $55 billion, the answer is still a definitive yes. This case study is the perfect example of how the accounting reality can be dramatically different from the economic reality.
Because we're talking about brand equity, intangible assets, the golden arches themselves.
Exactly. The value of that brand, their total dominance in the fast food space, the goodwill. DAP accounting just doesn't fully capture it. That brand value is the ultimate collateral that allows for this whole high debt strategy.
No bank is going to stop lending to a company that controls that much global real estate and has a brand that strong.
It far exceeds what's on the balance sheet as tangible assets. And the fact that 95% of the restaurants are off-book operators just highlights that gap between the static accounting and the dynamic economic power of the company.
So for a final thought, we've shown that McDonald's is making a calculated bet. High debt, max leverage, huge payouts. But that bet relies really heavily on two things.
Two things.
Perpetually stable rent checks and, maybe more importantly, perpetually manageable interest rates.
And there's the tension. If the company is this highly leveraged, what happens to that balance sheet and to those generous shareholder payouts when the cost of servicing that massive $52 billion debt suddenly doubles or triples? This high-risk strategy is only a work of genius as long as the cost of capital stays low. The moment that macro environment shifts in a serious way, McDonald's goes from being a financial engineering master to, well, to a potentially very exposed entity. And that's the tension you need to keep exploring.